January 10th, 2026, 9:23 a.m. Beijing time. China's State Administration of Foreign Exchange releases routine quarterly data revealing that Chinese holdings of US Treasury securities declined by an additional $73 billion during the fourth quarter of 2025. This brings total Chinese Treasury holdings to $797 billion, down from a peak of $1.3 trillion in 2013. The cumulative reduction exceeds $500 billion, half a trillion dollars, that no longer finances American deficit spending. Within hours of the release, US Treasury yields spiked 12 basis points as markets price and reduced demand from the world's second largest economy. I've analysed sovereign debt markets for 4 decades. I briefed Treasury departments on foreign reserve management when dollar dominance appeared permanent and unchallengeable. And what China is executing isn't panic selling or portfolio rebalancing. It's systematic extraction from dollar-based assets that eliminates strategic vulnerability while creating alternative financial infrastructure that could fragment the global monetary system that has operated under American dominance since 1945. Let me show you how $500 billion in Treasury sales represents the beginning of dollar hegemony's end, rather than temporary market adjustment. For decades, China faced what economists call the dollar trap, an inescapable cycle where export success created vulnerabilities that appeared impossible to address without triggering economic crisis. The mechanism was straightforward but binding. Chinese manufacturers exported goods to American consumers. Americans paid in dollars. Those dollars accumulated in Chinese central bank reserves, and those reserves needed to be invested somewhere. US Treasury securities appeared to be the only option that could absorb the massive dollar flows China generated. At peak accumulation in the early 2010s, China was adding $30–40 billion per month to its Treasury holdings. No other market was large enough, liquid enough, or safe enough to handle those flows. European sovereign debt faced crisis. Japanese bonds offered negative yields. Emerging market debt was too risky for reserve assets. So China bought treasuries by necessity rather than choice, eventually accumulating over $1.3 trillion, more than the entire GDP of countries like Mexico or Indonesia. This created the dollar trap. By holding so many treasuries, China became dependent on continued dollar stability and US economic health. If the dollar collapsed, China's reserves would evaporate. If treasury prices fell, China would suffer massive losses. American policymakers interpreted this dependency as mutual constraint. China couldn't attack the dollar without destroying its own reserves. This created what appeared to be stable equilibrium, where both sides had incentives to maintain the system. Chinese officials privately resented this trap, but accepted it as unavoidable cost of export-led growth strategy. The trap also created geopolitical vulnerability that became increasingly intolerable. By holding over $1 trillion in US assets, China essentially gave Washington a hostage. American officials could threaten asset freezes during disputes. They could use dollar clearing system access as leverage. Most importantly, they could sanction Chinese entities by cutting them off from dollar-based finance. China watched carefully as the United States weaponized the dollar repeatedly. Sanctions on Iran cut that country off from SWIFT, the international payment messaging system. Sanctions on Russia following the Ukraine invasion included freezing approximately $300 billion in Russian central bank reserves, supposedly sacrosanct under international law. Venezuela's dollar-denominated assets were seized and handed to opposition figures. Afghanistan's reserves were frozen after Taliban takeover. Each incident reinforced Chinese recognition that dollar-based reserves weren't truly safe. They existed at American discretion, subject to seizure, whenever Washington decided Chinese policies conflicted with American interests. The dollar trap wasn't just financial inefficiency, it was strategic vulnerability that could prove catastrophic if US-China relations deteriorated further. China's Treasury reduction wasn't impulsive decision or market panic. It was carefully orchestrated strategy executed over more than a decade, accelerating significantly after 2022 when Russian reserve seizures demonstrated that even central bank assets weren't protected from Western financial warfare. The extraction began modestly in 2014 when Chinese Treasury holdings peaked at $1.3 trillion. Initial reductions were small, $20 to $30 billion per year, designed to test market reactions and avoid triggering panic that could undermine the value of remaining holdings. As Chinese officials confirmed that gradual selling didn't cause Treasury market disruptions, the pace accelerated. By 2018, China was reducing Treasury holdings by $50–80 billion annually. The Trump administration's trade war provided political cover for accelerated diversification. Chinese officials could frame Treasury sales as a response to American tariffs rather than strategic repositioning that might antagonize Washington. This allowed larger reductions without appearing aggressive. The 2022 Russian sanctions proved to be the definitive moment. When Western governments froze $300 billion in Russian reserves, Chinese leadership concluded that similar actions targeting China were not hypothetical risk, but probable outcome of any serious US-China confrontation. Internal Chinese government documents leaked to Reuters revealed discussions where officials calculated that accepting short-term losses on Treasury holdings was preferable to maintaining exposure that could be eliminated entirely through American government action. The extraction accelerated dramatically. In 2023, China reduced Treasury holdings by $110 billion. In 2024, another $140 billion. By the end of 2025, total Chinese Treasury holdings had fallen to $797 billion, a $503 billion reduction from the peak. This wasn't portfolio rebalancing. This was systematic extraction designed to eliminate strategic vulnerability before it could be exploited. The sophistication lay in execution. China didn't dump treasuries in single transaction that would crash markets and destroy remaining holdings value. Instead, they sold gradually while simultaneously building alternative reserve assets that provided diversification without dollar dependence. Gold purchases increased dramatically. Currency swap arrangements with trading partners expanded. Investment in Belt and Road Initiative infrastructure created real assets outside Western financial system. Most importantly, China built alternative payment infrastructure that would enable trade without dollar intermediation. CIPS, the cross-border interbank payment system, was China's answer to SWIFT. By 2025, CIPS handled over $50 trillion in annual transactions, demonstrating that international payments could operate without American-controlled infrastructure. The immediate problem created by Chinese Treasury sales is straightforward arithmetic that has no painless solution. The United States federal government runs annual budget deficits exceeding $1.5 trillion. These deficits must be financed through Treasury security sales. When major buyers reduce purchases, someone else must absorb the supply or interest rates rise to attract marginal buyers. China's $500 billion extraction over 12 years averages approximately $40 billion annually. But the reduction has accelerated. Recent years have seen $100+ billion annual declines. This means that $100 billion in annual Treasury demand has disappeared, requiring alternative buyers to fill the gap. Who buys Treasuries when China exits? The answer reveals the unsustainable nature of current American fiscal policy. Foreign central banks as a group have reduced Treasury holdings, not just China. Japan, historically the second largest holder, has reduced positions to fund domestic needs as population ages. Saudi Arabia has diversified reserves following tensions over oil policy and human rights issues. Russia eliminated virtually all Treasury holdings after 2018. This leaves domestic buyers, American financial institutions, pension funds, and ultimately the Federal Reserve. When private buyers are insufficient, the Fed must purchase Treasuries to prevent interest rate spikes that would make deficit financing prohibitively expensive. This is debt monetization, the central bank printing money to finance government spending. The consequences are predictable and historically consistent. When central banks monetize government debt, inflation follows. The money supply expands faster than economic output, reducing currency purchasing power. Real wages decline as prices rise faster than nominal pay increases. Asset prices inflate as cheap money seeks returns, benefiting the wealthy while harming middle-class savers. This creates a vicious cycle. Higher inflation requires higher interest rates to restrain spending. Higher interest rates increase government debt service costs. Larger debt service requires more deficit financing. More deficit financing requires more bond issuance, and more bond issuance without sufficient buyers requires more Fed purchases, creating additional inflationary pressure. China's extraction accelerates the cycle by removing $100 billion in annual demand precisely when American deficits are expanding rather than contracting. The Congressional Budget Office projects that annual deficits will exceed $2 trillion by 2030 as entitlement spending grows and tax revenues fail to keep pace. Financing $2 trillion annually without major foreign buyers requires either massive Fed intervention or interest rate spikes that would trigger a recession. China isn't just reducing dollar reserves, they're building comprehensive alternatives that enable international trade and financial transactions without dollar dependence. This represents infrastructure investment that took decades to develop and cannot be easily reversed even if US-China relations improve. Gold forms the foundation. China has been the world's largest gold buyer for the past decade, though exact holdings remain state secret. Conservative estimates suggest Chinese central bank gold reserves exceed 4,000 tons, possibly approaching 6,000 tons. This represents $350 billion in physical assets that cannot be frozen, sanctioned, or seized through Western financial systems. Gold provides ultimate protection against dollar system abuse. If Washington freezes Chinese dollar assets tomorrow, that gold retains value. It can be sold for any currency, used as collateral for loans, or held indefinitely as a store of value. Its physical nature makes it immune to digital finance weaponization. But gold alone cannot replace dollars for international trade. This requires payment infrastructure enabling direct currency exchanges without dollar intermediation. CIPS development represents China's solution. By 2025, over 1,300 financial institutions across 100-plus countries connect to CIPS, enabling yuan-denominated transactions that bypass dollar clearing systems entirely. Currency swap agreements provide additional infrastructure. China has signed bilateral swap deals with countries representing over 40% of global GDP. These agreements allow central banks to exchange local currencies for yuan at predetermined rates, providing liquidity for bilateral trade without dollar conversion. When China trades with Brazil, Russia, or ASEAN members, increasingly those transactions settle in yuan or local currencies, rather than converting through dollars. The Belt and Road Initiative serves dual purposes, developing infrastructure in partner countries while creating alternative trade and financial networks. Chinese-funded ports, railways, and energy projects throughout Asia, Africa, and Latin America establish commercial relationships that naturally gravitate toward yuan settlement rather than dollar dependence. This creates geographic zones where dollar relevance declines while yuan usage expands organically. Most importantly, China is demonstrating to other countries that dollar alternatives are viable. When Russia was cut off from Western finance, Chinese payment systems provided alternatives that prevented total economic collapse. This proof of concept shows other nations that depending exclusively on dollar systems creates a vulnerability they can mitigate through diversification. China's treasury extraction isn't an isolated phenomenon, it's triggering cascade effects as other countries recognize that dollar concentration creates risks without commensurate benefits. Central banks globally are diversifying reserves at rates unseen since the 1970s, when the Bretton Woods system collapsed. International Monetary Fund data shows dollar share of global foreign exchange reserves declining from approximately 70% in 2000 to roughly 58% by late 2025. This represents structural shift rather than temporary fluctuation. Every quarter shows continued decline as central banks reduce dollar concentration while increasing holdings of euros, yuan, gold, and other alternatives. The BRICS nations, Brazil, Russia, India, China, and South Africa, are leading this diversification while actively building alternative financial architecture. The new development bank, headquartered in Shanghai, provides project financing without IMF-style conditions. The contingent reserve arrangement offers liquidity support during crises without requiring dollar borrowing. These institutions remain modest compared to Western-dominated IMF and World Bank, but they're growing rapidly while offering alternatives to dollar-based lending. Saudi Arabia represents a particularly significant shift. For decades, the petrodollar system, where oil was traded exclusively in dollars, formed a pillar of dollar dominance. Saudi Arabia's acceptance of only dollars for oil exports created automatic dollar demand worldwide. But in 2023, Saudi officials confirmed they would accept yuan for oil sales to China. By 2025, approximately 15% of Saudi oil exports settle in non-dollar currencies, primarily yuan. This matters because it breaks the automatic dollar requirement. If buyers can purchase commodities in alternative currencies, they need fewer dollar reserves. This reduces demand for treasuries that central banks held specifically to facilitate dollar-denominated trade. Each percentage point decline in dollar commodity pricing translates to billions in reduced treasury demand. The demonstration effects extend beyond commodities. When China trades with Indonesia in yuan and rupiah, other Asian countries observe that bilateral trade can occur without dollar intermediation. When Russia and India settle in rubles and rupees, other countries recognize they have options beyond dollar dependence. Each successful non-dollar transaction reduces psychological barriers to alternatives. The critical question is whether dollar decline represents temporary adjustment or permanent structural change. Multiple factors suggest the shift is irreversible, regardless of American policy responses. Infrastructure investments create path dependencies. Countries that built CIPS connectivity, signed currency swap agreements, and integrated with Belt and Road Initiative won't abandon those investments to return to dollar dependence. The sunk costs are too large and the strategic benefits are too significant. Political dynamics prevent reversal. Chinese officials, who recommended treasury diversification to protect against potential American sanctions, cannot reverse course without appearing to have been wrong. This would be politically fatal in China's system, where admitting error undermines leadership legitimacy. Similarly, Chinese public opinion strongly supports policies that reduce dependence on American-controlled financial systems. The demonstration effects strengthen rather than weaken over time. Each country that successfully diversifies reserves or conducts trade in non-dollar currencies proves to others that alternatives work. This creates bandwagon effects, where initial successes attract additional participants who further strengthen alternative systems. Most fundamentally, the geopolitical drivers of de-dollarization show no signs of moderating. US-China strategic competition continues intensifying. American use of financial sanctions as foreign policy tool expands rather than contracts. Each new sanctions target provides demonstration to other countries that dollar dependence creates a vulnerability. The United States cannot easily reverse these trends through policy changes. Even if Washington wanted to rebuild trust in dollar reserves, past actions have destroyed credibility. Once Russian reserves were frozen, every other country recognized that similar seizures could happen to them. You cannot unring that bell through promises that future reserves will be protected. January 15th, 2026, Federal Reserve officials testified before Congress that reduced foreign demand for Treasuries will likely require additional Fed bond purchases to prevent interest rate spikes. Translation: the United States will increasingly print money to finance deficits that foreign investors no longer want to fund. The inflationary consequences are unstated but mathematically inevitable. China's $500 billion Treasury extraction over 12 years wasn't just portfolio management. It was systematic elimination of strategic vulnerability that American policymakers had dismissed as impossible because mutual dependency appeared to constrain both sides. But China concluded that short-term losses from reducing Treasury holdings were preferable to long-term risk of total asset seizure through Western financial warfare. The calculation proved correct. Chinese Treasury reduction accelerated most dramatically after 2022, when Russian reserve seizures demonstrated that even central bank assets weren't protected. Each country observing these events drew obvious conclusions about their own reserve safety. Dollar holdings that appeared secure were actually subject to American political decisions that could eliminate value overnight. For the United States, the implications are sobering. Dollar dominance enabled persistent trillion-dollar deficits without painful economic adjustment. Foreign willingness to hold dollars, regardless of American fiscal policy, allowed consumption beyond production. But that willingness is eroding as China and other countries build alternatives that reduce dollar necessity. The mathematical problem has no painless solution. If the Fed doesn't monetize debt, interest rates spike and trigger recession. If the Fed does monetize debt, inflation erodes purchasing power and imposes real costs on populations. Either way, the era of cost-free deficit financing through foreign treasury purchases is ending. For China, the extraction represents recovered autonomy after decades of dollar dependency. By diversifying reserves and building alternative financial infrastructure, China eliminates leverage that Washington had weaponized repeatedly through sanctions and payment system controls. The protection costs hundreds of billions in potential Treasury returns, but provides insurance against catastrophic asset loss. The broader transformation extends beyond bilateral US-China relations to fundamental restructuring of international monetary system. The post-1945 architecture, where dollars dominated all aspects of international finance, is transitioning toward multipolar system, where regional currencies serve increasingly large shares of global trade and investment. This transition won't be smooth or quick. Dollar dominance accumulated over 80 years won't disappear in a single decade, but the direction is unmistakable. China's $500 billion extraction demonstrated that systematic de-dollarization is feasible, desirable, and irreversible for countries seeking strategic autonomy from American financial leverage. And once that demonstration succeeds, the psychological foundation sustaining dollar dominance crumbles permanently.